breakout. Gold's going to make a new all-time highs.
Gold-backed ETFs seen inflows of over $5 billion.
$0.8 trillion gold market.
Why are we the only guys that seem to understand this?
Makes your head spin. All right, welcome to this edition of Live from the Vault. My name is Shane Rand. I'll be your host. We've got an exciting call for you today. Just before we go into talking gold with Andrew Mcguire, just wanted to bring everyone up to date. As you know, Kinesis just released the Kinesis management system, the new interface. It's brilliant. It's simple. I'm in there now. You can just click on the dashboard and that gives you an overview. Also, you have access to all of your accounts, access to the exchange where you can buy or sell physical digital gold and, of course, digital physical silver as well. So with that, make sure you check that out, the new interface. It's included in your wallet when you download the Kinesis wallet for free. All of this is included for your account. So with that, it's my pleasure to go over to the UK and let's connect up with Andrew Mcguire from Talking Gold. Andy, over to you. How are you?
Great, Shane. Nice to be with you again, my friend. How's it going?
If it was any better, I'd be twins. But man, what a couple of weeks we've had in the markets. And I guess let's get right into this because there's a lot to talk about here. But I want to really deal with the elephant in the room here in terms of asking you, how is gold and silver currently being priced right now?
Yeah, that's a great question. And to be honest, that's pretty much the majority of what the questions that I've been getting especially over the last 8 weeks, to be honest. But look, I think last time we did spend a little time looking at the algo correlations, the algorithm correlations, which have actually been driving the BIS, and that was the Bank of International Settlements bearish driven action since August the 7th. And ever since that date, we've had a fairly heavy market. Now, the reason is, and this has evolved into some very odd pricing. Now, the COMEX casino really has evolved into a 99% algo-driven marketplace. And with the agnostic algos, which do exist, hunting for any correlation whatsoever, no matter how disconnected from real supply-demand fundamentals. And we've evidenced a major disconnect, really, which is right-footed, non-insiders. So in fact, let's look a bit closer. And this to kind of answer the question a bit more, because when we make intelligent trading or investment decisions, these machine-driven conditions cause an awful lot of confusion. In fact, the more financially intelligent you are, the less sense the action makes, unless you factor in that the house-controlled, high-frequency trading bots are able to directionally influence these largely neutral algos, which key off volatility, and they're simply seeking to scalp a tick either side of any generated movements in price. So really, it's those two factors. But look, there are limitations in rigging prices too low. And you think, well, okay, so where's the bottom? Zero? No, there are actual limitations. If you rig a price too low in a physically deliverable commodity, as we now see in gold and silver, and realizing these limitations, this machine-driven disconnect has created an actual fantastic opportunity for those of us accruing difficult to get physical bullion, and especially so in silver. Now, it's really important to understand that officials and insiders have hijacked this 99% algo-driven market to assist in manipulating all the key crosses. Now, these footprints are clear in both GC and SI. And if you remember, we use GC as the prefix for COMEX gold and SI as the prefix for silver on the COMEX. And I mean, these footprints are clear. Officials have stepped in to directionally chart paint correlations to incentivize the neutral algos to stampede literally into what is working, which for the last few weeks has been to automatically sell rallies into the downsloping 10-day moving average. It's unfortunately, guys, that simple, mind-bogglingly simple. As I say, the more financially intelligent you are, the less sense that makes when you know that the picture is much more solid, that the fundamentals are so strong for gold and silver. Now, look, as we say, there are constraints when it comes to a physical delivery cross, such as, GC and SI. And this is what we're now witnessing in both gold and silver futures, where the chart painted envelope is contracting between limitless algo generated supply and the point where real physical delivery obligations force the directional actors who are leading these neutral algos to steer these otherwise agnostic algos away from very large real world physical demand aggregations where the big orders sit. The reason they do that is because this is physical. They don't own and can't deliver. Now, this is the inflection point we witnessed last week when the aggregated real world bids were riding up along the rising 100-day moving average. And I think, so I say these levels so you can look at a chart and you can see these things. The 100-day moving average is a level that was deliberately front run by insiders. And stepping through the footprints, last Monday, the 28th, we noted the first bullish signs that these directionally orchestrated algo correlations were becoming actually bullishly disconnected. And there were really, I'd say there was probably two major factors involved in making this assessment. And the first indication was the fact that over the last 8 weeks, which is what we referred to before, this selling spree that occurred from the banking of international settlements sell-off, and that we identified some over 8 weeks ago, both gold and silver had become deeply technically and fundamentally oversold. Now, this reached a point where the GC and SI 10-day moving averages were nosediving into very large, rising physical paper and short covering flows. And we know from a wholesale market perspective where they sit, and they've been rising along and tracking the 100-day moving average, looking for a fill, basically. Now, the contracting window between what we're describing here is a downsloping 10-day moving average and a rising 100-day moving average makes it increasingly difficult for the house to maintain a cap on the 10-day moving average where, assisted by a little bit of surgical bid pulling, which is really all that they're doing. They're not taking the short side of anything here. It's leading algos by the nose. And these algos can be relied upon to sell every rally into the tens. So you pull a few bids there and let them do the work. Now, that was the first sort of factor. The second factor is the uncertainty around the upcoming US elections. Now, that's beginning to drive safe haven gold demand. This was, if you remember, this was exacerbated last Friday morning when Trump was tested positive for COVID. And it's times like this where uncertainty, and essentially this is talking about a black swan event, and unfactored tail risks drive a bid into gold and the dollar at the same time. And we saw that. And it's things like this that further serve to disconnect unnatural correlations. And sure, a bit of muscle memory, they come back, but they are actually, we're seeing these signs of this disconnect. So in this mindless world of the algo-driven, siloed COMEX casino, correlations work until they do not, after which fresh correlations are simply hunted out. This can, and it does flip in a picosecond, and as the herd really then decides to stampede into any other headline the casino chooses to spin, and as sure as heck, they don't want to be delivering physical. So there is a balance, as I say, and that's very important when you're looking. It should be a simple answer is what's driving the price. But, we're talking about a smoke and mirrors world here. Now, obviously, black swan events can catch out the orchestrators at any time. And if caught offside into a technical and fundamental oversold condition in a physically delivered contract, such a move has to be defended. And from a wholesale supply demand market perspective, the massive disconnect is what we see right now. So very short-term volatility aside, we expect the focus to now be on the upcoming election uncertainty, which was heightened certainly after Trump's condition was announced. And we saw those breaks in those correlations, which is something that we're looking for. And for those that want, we just drill down a little, because I know there's a lot of technical guys here as well. But just to explain in simple terms, the S&P and the GC, we call it the ES and the GC, and the ES and the SI correlations, they were the first to evidence a complete disconnect last week, certainly when Trump's condition was announced. But once again, the drama of this disconnect was evident as ES tanked and gold and SI rose. So this was a complete break in the prior correlation. Now, having this been broken once, this could now revert into an inverse correlation where gold is bid into a stock market decline, although I don't actually think we're going to see a stock market decline, but ahead of the election. But where we can see gold is bid into even a decline, and it'll rise with it. But also, if you think about it, these trades would be employed to hedge risk exposure into clearly unfactored headline news ebbs and flows, which really are the ignition fuel for these algos, just looking to gain any volatility they can. Now, these largely unfactored tail risks will be very assistive for all safe havens, and we expect gold to do what it says on the box into such uncertainty as it's done for thousands of years. Now, we would expect the bearish for gold correlations to continue to unwind, and as far as the dollar index is concerned, we would expect gold to rise alongside the dollar and possibly see the algos eventually latching onto that trade, which would be extremely positive. Now, as we summed up last time, rigging prices below equitable supply-demand fundamentals, really what it does is tighten up what little real bullion is on offer at market, and for in other words, at market being the price now. And it's immediately recognized by the wholesale market participants who competitively jump in to lock in cheap spot index ounces and tons of heavily unsustainable foreign exchange gold prices. And rather than drilling down into what spot indexing is, we covered that last time, and would strongly suggest, if you are interested in that subject, and how the mechanics of that work, is to go back to the prior video. But really, so to answer the question, it's this equation that determines the price support points. So what we have now is a lot of fiat chasing what little bullion is on offer, which further tightens supply, and the offer to sell bullion will rise to meet this demand. Now, given the enormous paper market leverage, this has obviously got a lagging effect on the price, but ultimately fundamentals will drive this chart painted technicals higher, simply as we explained, because these guys do not have the bullion to deliver, and if the bids are there, they don't want them filled. Now, you know, there's always a positive. With gold and silver so deeply fundamentally oversold, what the COMEX Casino has done is presented us an opportunity to swap our depreciating fiat currencies for bullion at deeply discounted prices. And that's the way I and a lot of our clients look at it. And I know you stackers look at it exactly the same. So in my opinion, this is about as close to alchemy as you can get. I mean, taking paper gold on offer and then taking it and converting it into physical gold and silver. I cannot think of a better way of doing this than really by taking the wholesale prices that Kinesis offer. But look at that perhaps in a minute. But the action we're evidencing now is so similar to what we saw on March the 23rd. And I think it's important to remember that bottom that occurred into a market breaking. And if you remember, and we did that, I remember live at the time, and we did it the following few weeks, and we kind of went through the detail of it. But if you recall, we discussed how the casino owners, which is the CME, self-regulated organization, in their desperation to re-liquefy the COMEX markets, brought an unprecedented volume of physical gold and silver into the casino. But by doing so, they exposed their Achilles heel, which is something we mentioned last time. The COMEX is now being called on for physical delivery, and we see those pressures build now, and eventually someone has to pay the piper. So, I mean, join the queue though. If you want to tap the COMEX for any size, it's not there. Lots of delivery demands for October bullion, and we talked about the October contract last time, which is normally a non-event. We saw all these contracts standing for delivery, which is most unusual. But yeah, we're seeing these come through. We're seeing some of them coming through, but nothing for delivery, but nothing is physically flowing out of the COMEX. Now, if you have a delivery obligation, and you pose this question to anybody sitting on a short position that they have to deliver, if you have a delivery obligation, why would you not discharge the collateral cost of holding and storing and insuring this bullion as quickly as possible? We're not waiting for a month to do so. So last time, I think we also looked at how both gold and silver blew the 40-year-old COMEX delivery process up, and because that was the first time it was ever put to the test. And it was discovered that paper gold simply could not square up hundreds of tons of physical delivery requests in the directly related over-the-counter market. Again, I won't dwell on that now. We did go through that in detail in prior webinars. But what we're witnessing now is actually very similar to when the market broke on March the 23rd, signaling a very similar setup to March, which has all the ingredients to propel a rally from a significantly higher stair step in very deeply oversold silver and gold. Now, we highlighted that in silver, that this stair step rally point is coming from plus $10 higher than the March rally set up, and $400 higher in a higher stair step in gold. And how these emerging stair steps, really, we've looked at how these emerging stair steps present a massive rally opportunity for us. Look, this window of opportunity is still there, albeit from a higher price. Just like in March, with gold in the 1400s and silver in the 12s, where we drew attention to what the market making insiders were doing, which was namely taking the long side of these tricked out machines who have no visibility into the real world of physical gold and silver supply demand constraints. So look, whichever way you cook the books, bottom line, this is the sole reason that gold and silver have become so disconnected from true supply demand fundamentals. And it is the market making insiders who are once again taking the long side of every tricked in sell order. And not to forget who's taking the long side of all the forced hedges. And don't forget that if there are institutions out there, large institutions out there who have physical to hedge or who have a long position to hedge, they're forced to provide to sell that position, but that still has to be bought back. And you know what? The house insiders, and these include officials managing the gold crosses, they're on the long side of this. And so basically, these are the guys that are long on against every short. Now, especially when you approach the aggregated support levels. Now, the September 28th lows look to have triggered another race into physical. Now, it's only muted by the machine-driven action, but the wholesale market knows different. Nothing of size is being offered for physical sale at current prices. That's a clue. This is because every insider knows that physical gold sub $2,500 and silver below $50 is way too cheap to sell, and they're accruing it. They're not selling it. Hence the tightness in supply. So really, if I wanted to sum this up, following this week's action, which we're now halfway through, and last week's action, we're halfway through this week, we've reached the point where chaotic mispricing of the underlying physical bullion related to GC and SI is going to force these algos to seek a better correlation, something that works. In fact, it looks like the correlation may be better placed to be inverse, as a physical market disconnect forces GC and SI to decouple from the whims of the currently active ES and DX algos, the dollar index algos. Now, ES has largely been in lockstep and DX has been inverse up until now. So really, I mean, even when you think about it, and I think we mentioned this last time, even if you were to actually think about this for a second, to connect the S&P 500 to a tiny, tiny market like silver is ludicrous. And no wonder you get these disruptions. It is absolutely ludicrous correlation. So, there's a huge upside here.
Mm-hmm.
Very short term, I think just to sort of really look at where are we in the weeds here. Golden Week holiday commenced midweek last week and extends into this Friday. In fact, they were supposed to come back today, but it's been extended for another day, an 8th day, which is very unusual, but anyway. So they'll be back on Friday. But when the Golden Week holiday comes in, people are usually kept on they get on their toes because this holiday usually keys off an overbought technical condition. Whereas this time, it commenced with both gold and silver in a deeply oversold condition, with very little open interest left to rinse. So it's much more likely that Asia comes back to a much higher price on Friday than when they left. So in other words, how much wrong-footed non-delivery spec supply can be chart painted in with insiders taking the long side of each sale versus competitive real market forces like ourselves, like you, who recognize gold and silver is deeply undervalued and are locking in prices for physical delivery. Shane, I know that's a long answer, but I'm sorry, you just have to look at the big picture.
It seems like the markets are quite turbulent right now, Andrew. And two of the biggest questions that I'm getting, and again, whenever people are watching live from the vault or talking gold, it's important that we continually remind we're talking about physical gold, we're talking about physical silver, but the two questions are, when we talk about physical gold or physical silver, what is the fair price for physical compared to paper or spot, whatever the spot price is? What is the fair price? And the second question that goes right along with that is, when is a good time to buy? Are there levels, or what is the best time to buy physical gold or physical silver?
Super question, Shane. I know you're a big silver guy. So, I mean, with regard to silver, these questions these questions really have exponentially increased since the Department of Justice began charging some of the very high-level bullion banks operatives and naming one of the largest making bullion banks, which is JP Morgan, as a criminal enterprise. And that followed last week by actual criminal charges being laid and jail time handed out. I guess they're not getting the 30 years that a RICO charge could do, but it could somewhere between 3 and 5 years. And this is into some people who were really quite high up the chain. So obviously this gets the brain going. Okay, so if these guys are out of the game, where's the price going? So, look, the regulatory scrutiny that is now on these banks will halt a lot of the price rigging we've endured since JP Morgan took over the Bear Stearns short position way back in 2008. If you remember, they took it over at $21.50. It smashed it down to $8.50, and all hell broke loose. And we even had Bart Chilton coming out and did an RT webinar. He did another one with Arcadia, and basically saying, look, yeah, it was JP Morgan, and we tried to get them to reduce their short position. They just actually increased it. I mean, so, long story short, we got tons of evidence, and thanks to dear old Bart, he confirmed for the record that this happened. So, and so really, since this date, there's been, and we've now got charges. So what resulted also in some deferred criminal charges hanging over this bank. Not only this bank, we also talked about Scotiabank. We did a webinar about Scotiabank, also, and Deutsche Bank, based So basically, these deferred criminal charges are hanging over these banks based upon their good behavior. Now, one of the primary tools for collusive price rigging has become too risky to use, which is of course positive. But let's not forget, JP Morgan is a primary dealer acting for the Fed, and the only entity with sufficient silver bullion to control the paper market using COMEX position concentration. But we see this price capping as unsustainable into a tight physical market. Now, look, you say, well, how's that possible if there's scrutiny? Well, having physical on hand allows them to add paper market supply that circumvents increasingly scrutinized position concentration rules. So, for example, if you rinse long stops to short cover, and then you can then galvanize your controlling physical position. And of course, that is not a one-way street. Silver is also competitively on the menu as at such deeply technical and fundamental oversold levels. So we expect these same short sellers to short cover and the complete gap to get closed fast enough to leave as many specs on the sidelines as possible, which is really what this game is all about. So really, ultimately, JP Morgan have cornered the physical silver market. Though they are going to benefit from a higher physical price, hence nothing of size coming for sale into any rigged sell-offs. Are you getting a discount when you go and get your try and buy silver into a rigged sell-off, into the lows we've seen in the last couple of weeks? Are you getting those prices? Because I sure as hell tell you that we can't. And we're in the wholesale market, we're looking for size. And what we're having to do is spot index, which is something that we discussed earlier about spot index and locking in a price, and then waiting as long as it takes to get physical delivery into next year. So if it was there, they would supply it. If it was of the correct value, they would supply it. So we see the least resistance as the upside, and we see very little resistance until 35 bucks silver. Now, obviously, we're still well below true supply-demand fair value prices. And when the ratio trade unwinds to its historical sweet spot, we easily see silver at 150 bucks an ounce. But that's even with gold at 2,500 bucks, which we think is actually the reset point. And we're also the subject of another webinar we did in one of the series we did.
Andy, while we're on this line, can you maybe just address and maybe talk a little about what is counterparty risk, and especially when it's, when we're talking about if someone buys SLV silver?
Yeah, another great question, and this is one I must get it almost every day, because obviously a lot of hedge fund, a lot of money managers really use that instrument because they're not allowed to buy physical, for example. They're allowed to buy shares, so if they can buy shares in a silver product, then that's their only way of exposure, other than, of course, physical. They could buy physical, which is what we try and steer them to do, actually. Now, look, unless you're one of the very few market-making bullion banks, if you're looking to receive physical silver, this is clearly not the right instrument for you. ETFs, as I say, are really still the preferred instrument for many asset managers. They're seeking exposure to silver or gold, for that matter. And it is probably not in their mandate to have direct exposure to physical metals. And yes, ETFs are directly influenced by the performance of spot gold and silver, but unlike physical gold and silver, these ETFs are susceptible to enormous counterparty risk, liquidity risk, management charges, just to name a two. And on the on and off ramps, this is what concerns me about SLV. The on and off ramps for SLV are in the form of unallocated silver. Therefore, especially given the smoke and mirrors accounting, and in the case of SLV, given the DOJ's comments regarding the custodian JP Morgan and their questionable management, I would contend there is a very real counterparty risk, as at some point the physical silver will sit on the balance sheet of an LBMA bullion bank. And what happens if the reset happens while it's at that stage, that T+2 stage? So bottom line, Physical metal held in your own name and stored outside the banking system is the only way to mitigate counterparty risk.
That's great, Andy. Now, I know that you deal every single day with a lot of the bigger trading houses in the world, basically. And what are you seeing in terms of the larger picture for both physical silver and physical gold?
Yeah, that's a good question. It's easy to lose perspective of the larger picture. You know, we get caught up in the volatility, the day-to-day volatility, and you know, really, this larger picture is important because we actually have a responsibility within this picture. And one thing that has been clear through the years is that a fair and honest price for gold was being circumvented by the ability to create limitless quantities of, let's underscore this, undeliverable synthetic gold and silver supply. Now, look, this has come at a price to the West. The result is that the paper market mismatches have been capitalized on by the physical markets, which have sucked so much liquidity out of the paper markets, has left them actually teetering on an ever dwindling supply of the underpinning deliverable gold and silver. And we've talked about the recent scrambled attempt by the CME to collude with the LBMA, a rival organization, to actually bring physical in to try and fix a band-aid over the COMEX. Now, look, regardless, the degree of leverage has reached unprecedented levels. The COMEX attempted to, as I say, regain the control of the paper market after this trust was lost back in March. But as we just discussed, having sucked in billions of dollars worth of bullion into the US, this has tightened up supply in the global markets and will ultimately put a target on the COMEX as a delivery market. That is not what was envisaged when the COMEX scrambled to restore confidence into a broken marketplace. So this beggars the question, how long can this unfair pricing system continue to dictate price? The answer is physical market dog is actually beginning to wag the COMEX paper market tail, and increased physical demand will speed up this revaluation process. Now, we've reached an inflection point where in the past, a buyer looking for big size took the position they didn't need to chase price, knowing that each month and the very large aggregated Bank of International Settlements derivative liabilities, they had to be defended, so dips could be actually relied upon to wait. You just wait patiently and watch them bring the market down so they can mark these massive derivative liabilities to market. And it's worked for decades. However, we're seeing these large aggregated wholesale levels being front run now by insiders who don't have the physical to deliver. They're realizing that they must perform. And this, especially when you've brought the bullion into the market now, and it's being asked for delivery. And if you're delaying delivery, you're starting to raise a red flag. And this way, you know, this is why in the past, prices have stair-stepped higher as the paper market liquidity leaches out. And you'll continue to see that, but I think we're going to see an exponential move higher as it's realized that this COMEX is now a delivery market and they have to perform. But this is where it gets interesting. The Kinesis monetary system is one-to-one backed by physical gold and silver. And by adding a yield to incentivize using gold and silver as a payment system, physical demand has the power to seriously influence the physical supply-demand equation. So this is where the power lays in our laps. Utilizing Kinesis as a payment system forces real physical gold and silver to be delivered into the Kinesis monetary ecosystem. Now, each gram, ounce, kilo, and ton minted into the Kinesis system discovers a wholesale price that is immediately deliverable, a real price, which has the effect of forcing discipline on the over-leveraged paper markets. Now look, it costs nothing to become part of this solution. Shane, you have a series of very, very short-term 2-minute videos that explain just how easy it is to use the Kinesis monetary ecosystem. And I really strongly suggest that you get on the Kinesis website, but also follow Shane, as I see regular updates coming through on the email systems where he is showing, running people through the various stages of how to use the system.
Well, the cool thing about that, Andrew, is that they're very short. They're only 2 to 3 minutes each, and they're very informative. I mean, this is the time right now. I mean, of the times in history, I think people should be paying attention to what's happening at Kinesis. Of course, one-to-one, physical back. The thing is that one of the KAUs or the KAG cannot come into existence without physical gold or physical silver. And it's such an amazing system. I just love it because it's genius, and it solves all of the major problems that we've been talking about over the last several weeks. Solution is Kinesis, the Kinesis money system. We've got the learning systems that are up there, and also the brand new minting videos, Andrew, are just awesome. I recommend, I'm sure we have a link right there below. Just click on that link where it says minting and go through those. This is what makes Kinesis just totally, totally unique. And finally, as we wrap up here, Andy, I was just talking in the beginning of the call just a little bit about the new KMS system. Have you had a chance to check it out? I'm on there live right now as we're talking. I'm on the system live right now. It's smooth for me. It's easy. It's simple enough that I could use it.
You know, it's and for me, it is highly intuitive. I think that's the thing about it. When I first ran through as a test on it with the team, and they put me to the test on it because I hadn't used it before at all. And my goodness me, it all makes sense. Now look, I'm a professional trader, so I expect very high standards. I was really impressed with the kind of level of information on this page, and I think, you know, you'll be really impressed too. So, you know, you've got charts, you've got everything there. And the simple ability to click, it's so intuitive. You click in, it takes you to the next page, no confusion. You know what, I know sometimes, I think sometimes when we're dealing with technology and you're dealing with people also who are perhaps new to ever having traded anything at all. And essentially, this is what you're doing. You're becoming a part of the solution, but you're also trading. You're empowering yourself to be your own central bank. And so it's really important. This is the perfect starting point for you to become your own central bank. So I would strongly encourage you. I love it. It's perfect. Really, I'm going to say perfect. Everything always gets refined, but this to me is exactly what I would need to start my entering the Kinesis monetary system and to use it.
All right. And if you can see the comments down below, I would encourage everyone to comment on the feature or the functionality that you like the best. You know, Andy, and we'll just wrap up with this. It's been a great call. And, but one of the things that I love the most about it, I think it's a little bit understated, is I've been trading physical silver maybe for about 15 years, maybe a little bit longer. And to this date, I cannot find anywhere in the world where I can buy physical silver or even physical gold at closer to the actual spot price, which we know is unbelievable right now. So I just love it for that. So if you're listening to this call, watching this call, just go to Kinesis Money. Everything is there. It's a free download to download the wallet. You can start with as little as $50. Buy a gram of gold and test the system. Others, I know we have some big investors that watch this and invest have a lot into the gold and silver, but I'm talking also for someone that just is looking for the future of money, which is physical gold and silver, digitalized, which is Kinesis. You can just go to Kinesis Money, download your free wallet, and start learning step by step. All right. So with that, thank you so much, Andrew, for taking the time to come on and visit us here live from the vault. It's been another awesome call, and we'll see everyone next couple weeks here on Live from the Vault.